the panel discussions again on the similar line. I think Bharat sir has also joined in, right? So I can't see that. So guys, we have been talking about the. Hi Bharat sir, good to see you after a long
Hi.
time.
Thank you. Thank you, Shashank.
Thank you. So we have been talking about the risk, and we have also talking about that how the technology dimensions has changed. So that's where that we or the topic of the discussion is going to be operational risk in banking, how the risk profile had changed, and what are the strategic measures being taken. And I have audience from the typically who has been always been driving the risk. So I'll not take the. We have Bharat sir, Raghav, Satyendra, Jay Dembani. We'll just when you start, you can just have a quick introduction rather than I take a time. But with that, I'll just get started with the discussions with Bharat sir. I will start with you. I think most of you might be knowing Bharat driving that. I think one of the first to set up the entire the security and the risk management to one of the major payment structure that the world has seen on the UPI, right? He was one of the architect, the security and the risk architect with that. So I think we'll just start the discussion from your perspective. You have seen the risk, entire the technology dimension changing in the banking, right? Be it on the digital payments, digital lending, across all the different things. And from those days to these days, what has changed and how it has impacted the entire the change in the risk landscape?
Thank you, Shashank, for inviting for this very timely and very important discussion today. Let me take you back 2 decades before the banking, the way we used to in India, and it was time when I'm talking about 2005 or so, when Basel III norms came into picture, where mostly we were talking about, so far, we were talking about the credit and market risk, but operational risk was never found a place anywhere in the discussion or in the practice. And therefore, nobody, even probably bother about the risk emanating out of the operational challenges. Thankfully, that was added as a part of the third pillar of Basel III norms in 2005, and operational risk found some good place into overall risk management framework. And the same time, I believe that technology also started entering to the banking sector. When I see the old conventional banking, naturally it was your bank, your customer, your ATM, your CBS, or your branch, and everything was within the closed loop of the banking, and very less technology, more as emotion-driven banking, because it was face-to-face banking where not too much of middleman required, or not even technology. Forget about anything else. It was on red ledgers. Moving from one table to another table, and therefore it was fully under your visual supervision or kind of control, where you used to see things happening around you. Thankfully, technology got into this, and that has changed the dynamics naturally. And we have seen the way technology has taken over on many things rather in our life, not only in the banking, but whatever we do today. But one part which is very importantly, if I would to do, I have to draw analogy here, where the market risk has its own very limited dynamics, which make little impact into day-to-day business, like the forex rate fluctuation, or some political issue happen in one part of the world, then it impact to the rest of the world today, because of the dynamics involved with the market sensitivity. That those events are much less in number of I mean in terms of quantum, but it impact heavily. Let's say, for example, when Ukraine and Russia war started, or some tension happened in the Middle East or Gulf, naturally the crude price goes up, and that impact a lot on the market. But again, that is not something an isolated event which is happen just on the fly. Credit risk, again, it is structured process, where your risk writing, underwriting, value at risk, which is very thoughtfully analyzed, and then only the risk is taken. Operational risk is not there, and that's where I'm coming from, because yes, technology has made our life so easy today, but technology very dynamic, and we are so much dependent on technology, be it insurance, be it payment, be it lending, or whatever we are doing today in the banking. It is purely technology driven. Fortunately or unfortunately, technology is very, very dynamic, and risk emanating out of the technology are equally dynamic. A few years ago, we were not bothered about information security. Forget about cybersecurity. Those who are, hearing about information security as a buzzword right now, but that was the thing people used to talk 10, 15 years ago. There was no cybersecurity, it was just information security, but it was just tick in the box sort of thing, because we want to make sure that whatever laptop we are using or computers we are using have at least the antivirus installed onto this. These have changed from that antivirus to the today we are talking about the XDR, EDR, SOAR, and all kind of thing today, where that itself shows the technology dependency has gone multifold. At the same time, the risk emanating out of such technology is also multifold, and that's the pitfall of this. Like you see the data breaches. Do you see the kind of massive fraud happen, like the Cosmos Bank is classical example of the operational risk due to the technology failures. Now, in that environment, if we are talking about the operational challenges, my simple funda about operational risk is that what you see right now may not last for tomorrow, and what is come tomorrow is not going to be there day after tomorrow. So you have to be prepared for so much so dynamic environment in I mean, it's not limited to the banking. It is across the world, across the industry, because there is no industry today, if I'm not wrong, there is no industry today where they are not using technology and they're purely on manual and certain things. So the operational risk is taking driving seat today in terms of managing risk, because rest all are model driven or data driven or principle driven. There is no principle in operational risk. It can happen anytime. Any technology go for failure. Anything can happen which cause the business continuity failure, and so on and so forth. So that's my initial remark, Shashank.
No, thank you, Bharat. I think it was very beautiful, great insight. So, Raghav, I'll come to you. So, primarily, Bharat brought a very interesting point that earlier days, lots of the things was happening in the physical mode. So, you had a very clear visual supervision of those risks also. I think SFB is also now going through that kind of the transition that large banks or the private banks have seen. SFBs are deploying the technology transition. And they continue to have both that. So emerging side of the digital risk as well as the continued physical manual activities continue to happen. So how do you see that a small finance bank, what are the risks that emerging in a stage of the digital transformation which is taking place, and how do typically small finance banks are responding? Especially, I've also come to the point that typically SMBs may have also the limited resources in terms of the technology as well as the people skills. So how do typically in that context small finance banks are responding?
Thank you, Shashank, firstly for inviting me over here. And I would say that I'm really happy that SFBs are, getting a separate space and are being talked of on such platforms. So as we talk of Shashankji, like as Bharatji also has set the pretext. So I'll tell you, I have been with the bank since we were a local area bank, and we were operating in a very limited geography and with very limited portfolio. And then we eventually converted to SFB and then started operating in different areas, and we scaled up. Now, I have seen over the years that how the banking has changed, how the technology has evolved very frequently and on a very fast pace. So with that, we have also seen that the way the banks, the way the organizations, not only the banks, the entire BFSI industry, that is the working style is changing, and even the from the regulators' perspective, they also expect from us, the every regulated entity, they are expected to work on the utmost you know, I would say s- the utmost best practices they are expected to follow, right? So I have seen how we have moved out from very simplistic approaches to a very SOP driven sort of approach, and this all is being done with the single objective of risk mitigation, right? So we have moved out from the human dependency atmosphere, and we are now, focusing on that how everything should be in a manner. It should be the institutional memory should be created for everything, so that the human dependency on every aspect can be reduced. We cannot carve out the human involvement, but at least
Okay.
the like we talk of the resilience, so the business should not be impacted, and there should be a BCP plan, so that the functioning of any organization should not be dependent on a particular person or a group of persons, right? So this has changed over the years, and this is the same thing which I feel that the regulator is expecting from any of the entities. And as we talk of the SFBs, like you said that about the limited resources and the separate set of challenges which the SFBs are facing. See, I'll acknowledge that there is a set of separate target customers which any SFB would be having. Like we are chasing a separate set of customers. My other peers would be chasing a separate set of customers within the SFB space also, like MFI and non-MFI space, or maybe as compared to the other universal banks. So there are some separate set of challenges which we will have depending upon the population we are targeting. Now, the resources, obviously, yes, they are limited with the SFBs, but I would say from my experience that SFBs are not any way behind the other um universal banks or any other peers working in this industry from the technology point of view, as far as the risk mitigation or the risk perception is concerned, right? So we are using various different technologies. That's fine that we may not be using the very monopolistic technologies and leaders in the space, but yes, we are trying to mitigate the risk to the best possible through the use of every technology solution best suitable to us. And the SFBs are working hard to evolve in this space, given the challenges they are having, and special attention from the regulator also at all times, being a new working model. So I would say that the SFBs have evolved over the time, and they have worked on the solutions so that the best practices can be laid down for the other SFBs also coming to play in the future. So that is from my side, I feel.
No, thank you, Raghav. And I think I missed out to introduce you. So Raghav is Chief Risk Officer for the Capital Small Finance Bank. And I know the role of the CRO is getting tighter and tighter. That I can imagine. With now, so moving from another CRO to another CRO. So Satyendra Sharma is with me, Chief Risk Officer for CSB Bank. Hi, Satyendra, and thank you for joining us. Now, I think one of the tough job, and please put up from your perspective, I may be wrong. Now, typically the job of the chief digital officer or the chief technology officer is to continue to focus into all the transformations, right? Transformation, including that on the bank side of it, as well as the working with the fintech partnership and all those things, right? And most of the banks, especially the smaller mid-tier of the bank and SMBs, are continue to drive towards a more partnership because it makes lots of business sense. Now, in that context, how the role of the CROs is continue to change, and how do you collaborate with the CDOs and the CTOs to ensure that the bank's risks, which is your own responsibilities, continue to be managed well?
Thank you, Shashank, for inviting me on board for this important discussion. As you mentioned, it's very challenging for a CRO to sort of coordinate with CDOs and CTOs, where they are basically IT guys, and IT is altogether a very specialized area. Another challenge has been added because now we have a Chief Information Security Officer, CISO. Now that is also a separate entity which is reporting directly to Executive Director as per the latest GRC guidelines.
No,
so we have to take care of two parts. One is providing IT services, which is taken care by our CTOs and CDOs, and as well as the IT information security also. we have to see that the data, whatever is there, that is also protected, as rightly pointed out in the previous presentation, that we have DPA Act, which is there in place. So a lot of responsibility on the banks as in a fiduciary capacity of the data of the customer, which is very sensitive information. So we have to ensure that that is there. So coming to the point of dealing with the CDOs and CTOs, yes, they are the people who are looking for IT transformation. And we have to look from the risk perspective that whatever the processes are put in place, say for example, the product related items, products have to be necessarily put through a rigorous process of risk evaluation and evaluation and approval process, which has to go through a committee, which involves people from, of course, IT department, people from information security department, people from inspection department, compliance officer. They're all the members of that particular committee, which evaluate the particular process or product, whatever comes to them for a discussion from all perspectives, which provide clearance. So the product is definitely, when it is launched, it is a viable product, it is safe and secure and meets the expectation of the customer. So that is one before the launch of the product. Apart from that, processes have to be up and running 24/7. That is the expectation of the customer. So services have to be rendered without any hindrance. Downtime should be minimal, and customer experience has to be really of top notch. So all those things are the requirement from the perspective of IT transformation. And second part comes from the information security part of that. So the we have in fiduciary capacity, as mentioned, we have the data of the customer, which is very sort of sensitive data, and it has to be protected at any cost. So regulator is also watching it very closely, whether we deal with data in our capacity as a banker, or even we may have some third-party arrangements also. Nowadays, a lot of other arrangements with fintech, other things are also there, which may also have access to the data. So that has to be regularly monitored, controlled. Proper service level agreements have to be there. Due diligence has to be there for all third-party or outsourcing services, which we are arranging for. So these are the things we have to necessarily look into.
No, thank you, Satyendra. Jay, I'll come back to you, but before that, just continuing pointer from Satyendra, and we'll go to the Bharat. I think, but Satyendra brought a very important point that today's customer expectation of the 24/7 of the services availability. And I think that's why one of the focus from the RBI in the new guidelines is a lot more on the resilience part of it, right? So how do you see that why the resilience has become so critical, and where that resilience that you are looking at it is only that on the digital, or there are multiple dimensions where the resilience need to be there, and how do you typically respond to?
Let me answer your question with very different examples, Shashank. 10 years before, when a bank network or system is down, it wasn't, and anybody used to notice even.
Exactly.
Because there was no dependency. Today, if UPI is down for 2 minutes, it will be a national crisis. It goes like that. Is the most important event of the day, because it's down. Now it is because everyone wants always on, and that's a habit which we have created, right? We have provided that kind of system, and people demands that resiliency. Naturally, when you are expanding your horizon about your operations and your technology and facility, customers are expecting every day something better and better, right? So resiliency has another aspect of that today, see, I'll give a different dimension altogether. I'm sure that out of 6 panelists here, at least 5 do not carry wallet anymore, because they carry mobile and they do everything using mobile. Now, the resiliency means that if you do not maintain that resilience in banking sector today, that means you are depriving customers from using your day-to-day requirement of making payment, right? That we have reached to that level where if you do not carry wallet, you carry just mobile and you want to buy something, and that may turn into the customer inconvenience, which RBI or the government, nobody wants to make that thing to happen. So therefore, the resiliency has gone as a part of the DNA of their offering, whatever it be. Digital lending is what? Just in few seconds, few minutes, we want, to customer to onboard and lend, and, let the, amount, give it to him in his account. Now, in all this kind of activity, the thing which used to take weeks and months, you are lending in few minutes. naturally you extended that expectation so much so high. So resiliency is part and parcel. And just to summarize that, as a healthy environment, growing economy like India, where if even smallest failure in the system or breakdown in the failure may cause serious damage to the market, which nobody can afford today. So therefore, in the interest of the economy, in the interest of the ecosystem, resiliency is must mandate as regulate as per regulator. It is a mandate, and there is no second thought around this.
Thank you, Bharat. Now coming to Jay, so Jay Dembani, thank you for joining us. He is a product head for HyperVerge, and Jay, I really congratulate you creating an affordable solutions and timely solution in the today's context, right? So now you have been interacting on the both the side. One is on the control leadership at the banks, be it on the CRO, the CISOs, but also the business product heads, CDOs and the CTOs. How do you see that? What are the challenges that you come when you are interacting on the positioning that, especially on these identity solutions and all? What are the different risks that you perceiving, which coming from the product side as well as the control leadership like CROs and all?
Thanks, Shashank, for having me on the panel, and thanks everyone. It is great listening to all the greats of Indian financial ecosystem. So Bharat sir has already, set the stage for the different types of the risk, where he talked about the market risk, liquidity risk, compliance risk, operational risk, and the credit risk piece of it. Where we largely interact with the C-suites is the last three risks, which is basically on the compliance side, on the credit side, and on the operational side. We work at the intersection of these three risks. Now, my colleague Karthik has already explained what we are exactly into. So the intersection, as I said, we operate in that direction. And whenever we work now these days, we are seeing a transformational change, in banks also, initiated by fintechs. By now, it's grooming well within the banks, where, we are seeing a proper risk evaluation framework depending upon that type of the risk they have in mind. So when we talk about compliance, operational, and the credit risk, what we have understood as a framework is that they are more into first, starting off, they're very keen to identify the risk, right? So if you're onboarding the customer, where exactly the risk will come from, right? Now, if I have identified a risk in terms of the pre-onboarding case, and so the way, we do this customer journey, our interaction is largely in the onboarding piece, is pre-onboarding and the post-onboarding. So whenever any customer is getting onboarded, how do we identify the risk? And then if you have identified the risk, how do we assess, right? Because there is high chances of having false positives, and false negatives over there. So how do we reduce, right? So how do we assess what is the business impact of this risk? And then once we have assessed it, then, how do we measure it? Like, how do we quantify the business impact of this risk? What if the fraudster enter into my system? Again, it goes back, it ties up with the credit risk, because, it depends on the type of the loan, right? If it's a secured loan or unsecured loan. And once I have measured it, how do I mitigate for it, right? Because every piece of technology will come with a cost of it. Would it make sense for me to go after, let's say, a pocket size loan and have this much of validations in place, right? Having anti-money laundering checks in place. So again, identification, assessment, measurement. And after that, once I have onboarded the customer, how do I monitor them, right? On a continuous basis, right? Where is that regular checks, re-KYC, which is happening in the system. And then, there is a continuous monitoring checks, which have been regulated, which have been, required by regulator also now. And having all done that, right? As a C-suite executive, I have also stakeholders to respond to, right? So what is the reporting mechanism, right? And what is the frequency of that report is something, we usually get into these conversations. So basically, intersection of these three kinds of risk: compliance, credit, operational. And within that, we have seen this framework. What we have said is that identification and how I basically evaluate the cost. So there is an increasing awareness. Raghav has rightly touched upon small finance bank. We work with small finance banks. We have worked with State Bank of India. We are currently working with multiple banks, and we are seeing this, revolutionary change in the C-suite, as Bharat sir has highlighted, because, the days of those, like responding after 10 hours, something is down, people, They were not having any means. These days, customers expect the level of experience because they have been, pampered by the fintechs, right? Every time I would expect a 2-minute loan or, my ability to transact, with the help of UPI. So that kind of conversations, when we get into, the conversations become very interesting. They're talking about, a complete systemic risk, not just about a particular aspect. So there is a lot of cross-functional. We talk with chief risk officers, we talk with chief product officer, and Sarah has rightly pointed out that you have to involve everyone. Right? Samir in the beginning itself also talked about that. You have to involve everyone. So there's a lot of stakeholder management. It's not just one department. We have to take sign off from the respective C-suites, especially including, info security officers and chief risk officer, along with the product managers.
No, thanks, thanks. It was very important. I think, meanwhile, I continue the discussions. Guys, anybody has a questions? Anybody has a questions, please put up the question in the Q&A or raise your hand, or you can mention, Naveed, and please, you can just allow the mic for Naveed to ask the questions. And please, if any question is targeted toward any of the panelists, please mention take the name, or if it's open, you can just ask open question. Akshat, can you? Meanwhile, guys, as the session continued, please share your feedback. Feedback form is already available in the Q&A in the chat box. So it's always help us to continue to improving ourselves. So please share your feedback. I think we're finding a challenge. Naveed, meanwhile, if you can request if you can put out the question in the Q&A sections. Meanwhile, I'll continue. Raghav, just come to you. That's also as a CRO. I was having a previous sessions where that how the role of the board you see the changing and how the CRO is conversation is on the board, especially on the larger side of the risk that is been emerging.
So Shashank, like I have seen that the board getting more and more active these days. So with the increased responsibility, not only on the executives of the bank, but also on the board. The board is, expecting a more output-oriented approach from the officials also. So the CXOs, particularly the CRO, the role is becoming very complex and very, hyperactive these days. So the CRO is expected to be multi-dimensional at all times and work on all the security aspects, all the risk-related approaches, and all blocks to be put in one place at all the time. And considering that the technology is also evolving, so as the responsibility of CRO is also increasing, and the increasing number of threats from the technology also. So it's more and more complex these days, I would say.
No, absolutely, I know. And it's now these conversations are not happening only at the time of the board meeting, right? It's throughout the year.
No, there's nothing now, just a fixed approach for this. So it has to be dynamic at all times, and and even I feel that it is more flexible and fruitful for us also. So we are also able to reach out to the board at any time for any of the discussions, and it leads to more result-oriented working style.
Sure. No, I'll just try to bring that last very important aspect for the risk management perspective. So we have been talking about the digital banking and we have seen on the innovation. So Satyendra, how do the organizations or what are the measures that they should take to also continue to drive the innovation as well as continue to ensure that risk has been well managed? So what are the different measures that need to be there? Because you can't cut down the completely innovations, right? So what are the different measures to be taken?
Yeah, Shashank, as you mentioned rightly, innovation is the way forward. Technology evolving at a very fast pace. It has never been like this. It is an unprecedented kind of pace we are seeing today, observing today. And the thing is, with that pace, a lot of other things which are undesirable also evolving. The kind of frauds are happening, the kinds of cyber threats are happening. They are also evolving. So we need to be sort of proactive rather than active to certain incident. Suppose some incident happens, some threat happens, and then we start reacting to that one. Rather than that one, we have to be necessarily on a watchful mode. We have to have security operations centers up and running, monitoring real-time basis. We have to keep monitoring our dark web, sort of monitoring and all that also regularly for see any kind of risk which is emerging, which something can come out of nowhere like nowadays. So we have to be very careful. We have to be on our toes to look for the emerging risks and to counter them. Our security system should be regularly checked up. Control should be in place, and of course, monitoring has to be top notch. BCP has to be in place. That is a very important point. Business continuity process policy, as well as our disaster recovery. We should have alternate sort of servers available, DR sites available, and as elaborated in detail in GRC guidelines of RBI, there has to be a proper governance structure, proper system of managing these risks. So we have to, like operational risk principles are there. We have to identify, assess, manage, monitor, mitigate, and control. So all those things are there. We have to necessarily be looking at all our systems are adequately secured. Our access controls are properly being monitored. Customer data is definitely the very important asset to any bank or any institution that has to be protected at any cost, and of course not compromising on the innovation front. So this is how the way forward.
Thank you, Satyendra. And coming to Bharat for the last some thought, I think you've been one of the architect for the best of the innovations, which is UPI, and also you manage the risk, right? So maybe your last thought that how the organization should continue to drive the innovation as well as able to manage the risk. I hope you're there.
Sorry, there was some signal issue at my end. Can you please repeat?
Yeah, no, Bharat, I was taking that, continuing the pointer from Satyendra, the last thought from your side. As I was talking about that, you have been architect of the UPI part of the team, and which is one of the best innovation in the financial segment, as well as able to manage the risk better, right? So how do you see that organization should continue to drive the innovation as well as manage the risk better?
So, well, I heard Satyendra talking about the proactive than reactive. I think that's the key of any successful risk management, using innovation with the technology, because, you know, when it comes to any cyber threat today, yes, it is impossible to manage every threat proactively. However, it is all about if there is a cyber threat, how fast you can detect, and the moment you can detect, how fast you can respond to that. That's where the whole key is, because, you know, when you are waiting for some event to happen, and then only you, like, you know, digging a well when there's a fire, that doesn't work in today's time. Second, the innovation. You know, when we built UPI initially, there wasn't any benchmark anywhere in the world. So you need to be very, very pragmatic in your approach, because innovation is like a security or risk particular. And I have fellow CROs on the panel. They may agree with me that security and risk are always considered as a roadblocks or kind of speed breaker and things like that. We are being treated like this because that's what your job is. However, risk team or risk people are the best people who know where to trade off, because yes, we know there's a risk, but we also know that because there's a business, there's a risk. It cannot be other way around. So there is a good trade-off always we need to keep, because you have to take a risk, and risk professionals are meant to take a risk. And that is what exactly I did during my UPI days also, where some of the risk you need to take very calculatively, because when it comes to any kind of technology failure or system failure or control failure, yes, it is a risk. People will be questioned first, but at the same time, they are the people, they think beyond horizon, they beyond the imagination that what can go wrong. And if that goes wrong, how we can handle that situation. So that kind of analysis, that kind of, you know, visualization is very, very important when you want to balance between the control and innovation. You know, let me give you an example about UPI. When we launched in 2016, you know, one of the capacity planning, like we just talk about, you know, resiliency. We designed the system, not only designed on paper, in reality, with 25,000 transactions per second, which we never thought of even. I mean, thanks God, it is demonetization, and then followed by pandemic, but UPI is going billion and billion every day. But that is where you have to bring those kind of innovation, even in the risk management. That okay, what if my sudden spike comes when people overnight adopt UPI? How we are going to manage the spurt in a number of transactions and overall environment? That visualization helped us naturally. So that is how you have to manage between innovation and risk. Yeah, mute, Shashank.
Sorry, thanks, Bharat. And last bit from Jay. I think Bharat talk about the risk guys continue to think about the future, like what can go wrong. And I think I imagine the product guys and especially the technologists also keep on thinking what other can go wrong. So how do you prepare yourself to continue to build solutions which is take care of the future risks that may emerge?
Listening always to Bharat sir, Satyendra sir, and the likes of, Samir always, that's
You're
one
right.
thing, where our knowledge gets feeded and our product roadmap decided. But, on the side note, I'll say, identity of an individual is a proxy to the trust, right? So everything what we are talking about today, banking is all about transactions, right? And transaction is directly proportional to the trust. And trust here is inversely proportional to the perceived risk. If, the identity of the individual and hence trust is high, the perceived risk is low. And if the trust is low, the perceived risk is high, right? So we are solving for the trust here. So every now and then, we regularly, look up to, we are doing continuous research, as, Karthik has already highlighted in the presentation, that we have been working on these problem statements. We work across the geography. So where the different problem statements, be it from Africa, where they are coming from, or for our customers in the US, or in Southeast Asia. I'll just cite an example. In Southeast Asia, we have built a system of sort of a framework which is able to scan through a duplicate record, 50 million records in few milliseconds. Now that's the spread at which we are working, because the rate of the fraud is very high. So we are constantly working towards the problems which can come in India. We're learning from the other markets, and the most important thing which we are designing our system is that risk-aware product design. Whenever we design something, we keep the customer at the center and see what are the kind of risk a customer would face. And how do you marry the concept of risk with the customer experience? Because we also have to design for the low bandwidths, right? So we are constantly thinking about customer by keeping them at the center. Our product management is largely customer-centric product management with a boundary of risk around it. So that's how, Shashank, we keep on looking forward. And we keep looking to digital fifth and reports.
Thank you very much. Thank you. So thank you. I think amazing discussions, and I think lots of the insights for the people that, okay, there is a way to manage the risk and there is a way to continue to drive the innovation. So thank you, Bharat. Thank you, Satyendra. Thank you, Jay. I think Raghav has dropped out because he has some meetings. So, but thank you everyone for taking out time and spending with us. Thank you very much.